So today we're going to be talking about HELOCs. HELOCs are a valuable tool that we have in the mortgage industry to help people, and it is also a valuable tool for consumers, for homeowners to have as part of their personal finances. Today we're going to explain what a HELOC is, how do they work, what strategies do we use them for in the mortgage industry, and last but certainly not least, how do you actually get one? So first question, what is a HELOC? So HELOC is a mortgage. It's a different type of mortgage than most people are familiar with, but it is a mortgage nonetheless. And HELOC is actually an acronym. It stands for Home Equity Line of Credit, which kind of explains what a HELOC is very well. So your home equity is the collateral for the line of credit. So maybe the easiest comparison is a secure credit card, where you go to the bank, you give them $1,000, and they tell you, hey, we're going to give you this credit card, and your limit is $1,000, and then it's safer for them because if you don't pay that $1,000 in your credit card balance, they're just going to keep the $1,000 that you gave them. So in a similar way, HELOCs typically get better terms in credit cards, higher loan amounts depending on the situation, and more favorable terms to borrowers compared to regular credit cards, which is unsecured debt. So how do HELOCs actually work? HELOCs are a bit different than a regular purchase or refinance loan that you're probably used to if you know about mortgages. HELOCs are adjustable, and they're even different from adjustable purchase and refinance loans. So in those cases, you have a fixed period of time, probably like most common is like 5 to 7 years of a fixed period, and then you have adjustments, and those adjustments can happen maybe once a year, maybe every 6 months. With a HELOC, it's completely different. So once you close, your rate is not fixed. It is changing all of the time, and it's changing based off of whatever interest rate that your HELOC is based off of. So the most common one that I see is the Wall Street prime rate. So your situation will vary, but whatever rate that is, plus your margin, that will be what your rate is. So the margin is determined by the investor who we're doing the HELOC with, and typically things like credit score and home equity are things that contribute to what margin you have access to. An example of how that work would be like you have a 1% margin, so the prime rate on the day that I'm recording this video is 6.25. You have a 1% margin that you've agreed to. Your interest rate for this month would be 7.25. And then if that prime rate goes up, then you will follow it based off of your margin. So if that goes up to 6.5, then the next month your interest payment will be based off of 7.5, and true in the opposite direction as well. Typically, there's caps and floors on these sorts of things. So when we go over your HELOC, we can figure out what those caps and floors will be and determine the limits on both ends of the spectrum. The calculation for how your payment would work is pretty simple, at least for the introductory period. They use the simple interest formula, which is loan amount times interest rate divided by 12. So just some quick math as an example, going back to that 7.25 rate, if that is what your interest rate would be, with $100,000 loan amount times 7.25% divided by 12, we get $604.17. So somebody borrowing $100,000 would pay $600 a month in interest in that particular month. And again, that would change basically every month that prime rate changes. The structure of a HELOC is also a little different. So you typically have an initial draw period, and that draw period varies by investor. But just as an example, let's say we have 10 years of interest only, and then 20 years of amortization. So that interest only period, you will be making payments every month, but you are not required to make payments that go towards the principal. So you can pay that principal back down so you could borrow more money in the future, or just because you don't want to pay interest on that money. But at the end of that 10 years, you will be forced to pay down the principal of whatever you have left. And lastly on this part of this question, there are frequently minimum initial draws, but also no prepayment penalties. So why would somebody get a HELOC? HELOCs are typically used interchangeably with a cash out refinance in order to tap into the equity of your home. And when rates are higher than they have been previously and historically, HELOCs typically make more sense, or if you need the flexibility of being able to put that money, take that money out and then pay that down and then take more money out again. So if you need that liquidity from that refinance, then a HELOC is a better option. For most people, they don't really need the liquidity, so in the past two and a half years when interest rates were low in the 2s and the 3s, people were just getting regular cash out refinances. But now that those interest rates are higher now, you're not going to replace your 2.5, 2.75, 3% interest rate with a mortgage that is well above 6%. It really just doesn't make any sense. So if you need to tap into your equity in your home, which a lot of people do have plenty of because of how the market has been, then the HELOC is your best option. You could sell, or you could take out a HELOC, and if you want to live in that home still, then you're going to take the HELOC. So you can have your first mortgage and then get a HELOC that's sitting behind it and tap into your equity that way. Some things that we see people use HELOCs for is debt consolidation to pay off credit card debt, especially if that credit card debt has much higher interest compared to what you're getting on the HELOC. Home improvements, that's a big one. Some people use HELOCs to take money out of their homes and then use it to buy other properties. So if you have enough equity in your home, you are able to take a large portion out and then use that as a down payment on an investment property. Even renovations, there's not really any rules of what you can and can't do once you have that money with a HELOC. So a lot of people do that for real estate investment purposes. And because you have that flexibility, if you go ahead and flip that home, sell it, you can pay that HELOC back, or you can keep it and start collecting rent and gradually pay that HELOC back down and then do that same process over again. And some people just get HELOCs for personal use. Sometimes HELOCs are also used on purchases to stay within loan limits. So in order to keep within a conventional loan, you may get a HELOC to kind of bridge the gap between what your ideal down payment is and what the conforming loan limit is. Typically, we only see that on the jumbo stuff. That is an option that we present for some of our clients when that makes sense and when that opportunity arises. So how do you get a HELOC? The loan process is fairly similar to that of a regular cash out refinance. You're going to have to fill out an online application. You still have all of the same different things that we look for. We look at income, we look at credit as well, and most of the time you do need an appraisal as well. So the loan process is very similar to a cash out refinance. Typically higher credit scores are needed on a HELOC. The lowest I have seen recently has been 680, and for reference, the 620 is the lowest on a conventional loan. And in most cases, FHA and VA, you can only go down to 580. So 680 is a lot higher than those two, so it is a little bit more difficult for some people to qualify for a HELOC. There aren't really any set from the top guidelines on HELOCs, but many of them do follow Fannie Mae guidelines on different issues that might come up in underwriting. The amount of money that you have access to from your loan amount is determined by your debt to income and your loan to value ratios, and that is something that we would find out while we are doing your HELOC in the very beginning stages. For a timeline, you should expect probably at least 3 weeks to start to finish on a HELOC. Could be more depending on the appraisal turn times and underwriting turn times for the HELOC investor. If you are interested in getting a HELOC, I do have a few different investors who are offering HELOCs that I have access to. So any questions that you have, or if you're interested in this product, please let me know. I am more than happy to help you.